Good morning. Today is Sunday and the date is April the 16th. The time right now in Singapore is 11:36 in the morning. And usually this is my regular Sunday webinar, which is conducted at 8 p.m. Singapore time. However, due to a dinner engagement tonight, I would have to pre-record this presentation for you. And there will not obviously be a live presentation this evening. Now, let's get started. Over here, let me get started before we get... new share. Right, I'm not sure whether you can see my screen right now, and let's get started. Right, a bit of a disclaimer before we start our regular session. And of course, this presentation is not an offer to buy or sell any kind of securities, be it futures, FX, CFDs, cryptocurrencies, or even even futures and options. So the trading of any kind of leverage products do carry risk. So do understand your own risk profile and your own suitability before you embark to trade any kind of these margin products. And of course, I will spend a bit of time to talk to you about the various markets and my view of their likely price action going forward. And these are, of course, my own opinions. I got nothing to do with my company, Traders Academy International Private Limited. So therefore, I will not be responsible for any action that you may take as a result of listening to this presentation. Okay. Now, the week started off with China's CPI numbers. CPI numbers in China, if you believe the numbers, is obviously nothing compared to what the rest of the world is experiencing. CPI number is actually quite benign. They are at 1%. There has been steadily been coming down from 2.8% in September of last year, and the latest number is the lowest since the start of last year. Okay, and it's at 0.7%. So what does it mean? It means there is hardly any inflation, if this number is to be believed. And of course, the flip side is that one of the reasons why there's no inflation in China is because demand is weak. So that could be the reason, which is a more overpowering reason when we look at the CPI numbers. Not only do we look at the local prices paid by mainland Chinese, we also look at how this inflation, so-called, is affecting the larger economy. So when you look at the CPI numbers, not only are we looking at inflation numbers, we are also looking at the state of the economy from the demand side of the market. Okay. So this is definitely a good number if you're looking at inflation. It is not a good number if you're looking at the disinflation. Okay. So then of course we have the Eurozone retail sales. Now, retail sales has never been a big thing in the Eurozone, but it does reflect the overall demand, okay? If retail sale is weak, obviously we say that demand is not there and the economy is weak. So this is the correlation. And going into this number, market was expecting negative 3.5. Now, it has been in negative territory for quite some time now, since it went into negative territory in June of last year. So we are already in the 9th month of negative growth. So we can see the overall Eurozone retail sales is pretty weak. Demand is weak because inflation is high. So that is one reason where earlier on when I mentioned China CPI number is weak, it's low, but we also look at it from the demand side. Okay, it's definitely not a good sign for the global economy. So this is at negative 3%. It wasn't as bad. It was still negative 3%. Okay, so then we have the CPI numbers coming out from the United States. Now this is traditionally taken to be a major number. Market was actually in expectation going to this number. You can see that the consumer price index, you take away the core, meaning to say you take away the food and energy component. This is the number that has more relevance, as to a lot of analysts, they are concerned. They say this one is more relevant. Is an 0.4% on a month-to-month basis. So you can see that last month was 0.5%, no, not last month. For the month of February, it was 0.5%, and March was 0.4%. So on balance, it does looks like inflation, it measured by the CPI number, is actually improving, meaning to say that its prices has actually eased back. When we look on a year-on-year basis, basically what it means is compare March of this year compared to March of last year, it shows a slightly different thing. Okay, it shows that the core, which take out the food and energy component on a year-on-year basis, is actually climbing up. So when we have month-on-month, which is more sensitive, coming down, but on a year-on-year basis is going up, it does shows that there is still inflationary fear, that is inflation, although has been coming down, is threatening to re-emerge. So this is the concern that is bothering the marketplace. And more importantly, what will the Federal Reserve do when you look at all these numbers? Of course, the Federal Reserve is not going to depend on just one set of data to decide whether to hide or not to hide, and if they hide, by how much. But I think they take into consideration all the numbers that we see on a week-to-week basis, and they take that into consideration. Okay, so in Canada, we see that Canada is one of the very first major central banks to actually pause the rate hike. In fact, Canada is one of the earlier banks that actually started off hiking interest rate way before the Federal Reserve. You can see that they started at least about the same time, not say one of the first. They started about the same time as the Federal Reserve, which was March last year. So you can see they have already paused. So is this setting a precedent for the Federal Reserve to also pause in the May FOMC meeting? Market is expecting at least one more round of rate hike of maybe 25 basis points. So let's see whether it does do that. Okay, but the Canada Bank of Canada is actually one of the very first to actually start to pause the rate hike, okay, maintaining at 4.5%. Now, of course, there are other central banks that do that as well, okay? Now, when we look at Australia unemployment is holding steady. In fact, it's coming down at 3.5% steady compared to February. Market was expecting a little bit of tick up, but there wasn't a tick up. It remains stable at 3.5%. Now, 3.5% means Australia employment scene is almost full employment, which is as good as full employment. Anybody who has been looking for a job can actually find a job. So this number, if you look at it in isolation, it's definitely showing us that demand is strong, the economy is able to withstand further rate hikes. So basically, this is a good set of numbers, giving the central banks more leeway to decide if they should decide to continue to rate hike. Based on this unemployment rate, you can see that the economy is strong enough to withstand further rate hikes. On the employment change, on a month-to-month, how many new jobs are being created, you can see that it has come down a little bit from 64.3 thousand jobs created in February. Now March, we have a bit of a downside to 53,000, but it is considerably a better number compared to what the market was expecting. Market was expecting only 20,000 new jobs created, 20,000 new jobs created. So this is definitely double of what the market expected. Of course, this number has notoriously been very, very inaccurate in terms of the forecast and the actual result. So we can say this is another example, market expecting a poor number, but it came in a lot better. So from this employment change, you can see that there is still a lot of jobs being created. Okay, so it means this is definitely playing into the good hands, allowing the Reserve Bank of Australia to actually give it a little bit more leeway to consider whether to further rate hikes. Okay, but what we see this week is that there is actually a pause in the Reserve Bank of Australia. So we can see that the harmonized index of consumer prices in Germany continues to fall from a peak in October of 11.6%. Now it's coming down to 7.8%. So this is again seen as to be a good sign, but 7.8% is still unbearably high for consumer prices to be at. Okay, we need the ECB target rate is 2%, very similar to what the Federal Reserve target rate is for inflation. So 7.8 is a long way from 2%. So the fact that we have seen easing prices shows that energy prices has basically been coming down, food prices has been coming down. So that is behind the reason why you can see the general prices has been coming down, but that could change very quickly. We can see this week, especially on Friday, we can see crude oil prices beginning to bump higher. So is that going to be something that we is going to set the standard going forward? Okay, on Friday we have retail sales in the United States. Again, this is another major number. Market was expecting a somewhat poor number. They expect 0.4, but it came in more than double than poor. Okay, market came in negative 1%. So retail sales is not doing well. So despite the employment scene holding out, despite prices coming off, you can see the retail sale is not doing well. So when you see CPI numbers coming down, you have to look at it from more angles. When you combine that with the retail sales, the reason why prices are coming down because demand is slowly shrinking. Okay, so this is definitely a poor sign for the GDP numbers going into the first quarter, which we will see next month. So do watch out for the first quarter GDP to be poor. Okay, so because we can see a bump up in January out of the blue, it came up 3.2%, but that could be an aberration. Since then, the market has gone back to earth to negative, and then now it's further into the negative territory. So this is definitely an aberration here. Okay, so not sure what happened that caused the price this index to actually go up so much relative to what it has been doing throughout the whole of 2022. So now you can see the price is back to where it is normally trading. And if you minus this 3.2 rise in January, prices retail sales index has been actually been in negative territory. Okay, so do take that into consideration. If you take away this big bump up in the retail sales in January, retail sales January is showing us that US demand is actually shrinking. So that is, like I said, is going into a GDP first Q1 estimates for next month. I think it's going to be a poor number. Okay, so we have the last number that came out this week itself. We have the Michigan Consumers Sentiment Index, which is actually very good. It has gone up again. Market was expecting only a marginal increase in confidence to 62.7, but it came in 63.5. So again, US consumers, despite them slowing down purchase, we also saw durable good orders also has been coming down. So big ticket items, they have stopped buying. Retail sales is slowing down, and then confidence is still very high. So this too doesn't seems to be painting one picture. It's painting a very complex picture here, while very confident it remains high, but people are not spending. So at the end of the day, you need people to spend, right? Confidence is one thing. Confidence needs to translate into actual consumerism. If confidence high, but consumerism is on the decline, definitely the GDP is not going to be doing very, very well. Going into the rest of into the coming week, we're going to have big numbers. From China, we have GDP numbers for Q1, and Q1 is expected to be to be a major improvement from 0% to 2.2. Okay, so so this is the Q4 of 2022. China GDP on a quarter-to-quarter basis was 0, no growth. Okay, and then this time they expect a 2.2% bump up in GDP, which is a very, very good estimation. On a year-to-year, they expect a bump up of more than 1%. Previously, last quarter of 2022, it was 2.9%, and now on an annualized basis, they expect it to be 4%. So China is expecting a good number going into Tuesday. So retail sales-wise is still weak. We don't see that being translated into more people shopping. So retail sales is likely to take further hit from negative 11.2. From what we're talking about, from 3.5% to 0.8%. So we can see that the retail sales is expected to shrink. Okay, in the first for the month of March itself. Okay, after the bump up in Chinese New Year, we can see prices are coming back to earth. Okay, so in the UK, in terms of labor number, we can see claimant counts. They expect negative numbers, expect a negative 11.2 thousand new jobs lost. This one they're expecting further losses for the month of March from negative 11.2 to negative 11.8 thousand jobs being lost. On the jobless rate front, they expect it to hold stable at 3.7%. So again, there's probably no surprise there. Canada expecting the CPI numbers on a core basis on a year-on-year basis to be at 4.2%, further decline in the retail prices from last month, from the month of February, from 4.7 to 4.2. Let's see what happens. UK is also expecting CPI numbers coming on Wednesday. They expect further pullback, but still it is in the double-digit range from 10.4% to 10%. Okay, so New Zealand also expect CPI numbers coming in on Thursday morning. They expect a bump up from 7.2% to 7.5% on a year-on-year basis. And then came China central bank interest rate decision. No estimate here, but it's likely to be 3.65%. Okay, Germany also expect PMI numbers. We expect composite at 52.6. No consensus here, whereas manufacturing, they do expect further decline to 44.5. Anything below 50 is contraction. Okay, Eurozone also have composite PMI. They have no estimates. UK services PMI, no estimates. and Canada retail sales expects to string back to no growth. Okay, so there you have it. The first part of the week is going to be exciting because we have a lot of CPI numbers coming out. Then we shift target to Europe. US is likely to be very, very quiet. Okay, so let's go into let me see. Let me share with you this one. Right. Let's get started. Sorry, I'm not supposed to show you this. Hang on. This is where I always get stuck, right? Sharing the screen. All right. So this is the chart for the Dow Jones Industrial Average. This is the 4 hours time frame. You can see that this week itself we have a continuation of the rally from the mid-March low of 31,429. This week we have a new high at 34,082.9. Now this is the highest in this month, and definitely the market is definitely elevated on the belief of one thing. Okay, the market has been telling us they are betting against the Federal Reserve because nobody believe, or at least the majority of the market believe, that the Federal Reserve has no choice but to start to pause and maybe even pivot in the second half of this year, because something has obviously broken. The banking crisis that we saw in March is the result of very high, very steep rise in interest rates. So market participants believe that the Federal Reserve now do not have a lot of leeway in which to continue to hike interest rate aggressively. So this is the scenario behind the rally in equity prices. But we can see that this rally has not have conviction in the sense that the volume has not been matching the rise in terms of magnitude. So in my personal opinion, I do believe that this rally could be coming to an end soon. Perhaps it may have already ended this week. So the high traded this week is 34,082.9. So what we see on our lower time frame, you can see Friday upon the release of the retail sales, we can see there was a pretty sharp sell-off from the high of 34,082.9. So this could be setting the stage for further losses going forward into this week itself. So for those who are still long, just be very, very careful. I am not comfortable buying a US equity index at this particular point in time because I think the upside is very, very limited. At the most optimistic, challenge of 34,712 may still be in the card, but again, if it is challenged, whether or not it can sustain is another story. You know, what I'm more concerned is that 34,331.5 is going to be the immediate hurdle. Okay, if you can cross, well and good. If you cross and couldn't sustain and turn around, that could be another selling signal. So I'm now looking out for selling signal. On the daily time frame, do we see any signs that the market is about to turn? Not yet. Okay, we have a bit of a pullback here, but it does not end up in a classical reversal signal. Definitely, I will not trust the lower time frame yet, because although we have an outside bar here on the 1 hour, but 1 hour is a very small time frame compared to the larger scheme of things. So do not go short just yet, but do monitor these equity markets going into the coming days. You see, in the S&P 500, we also have the same situation in a 1 hour time frame. Market traded to a high of 4,163. Okay, and then the markets end up on the 1 hour itself upon the release of the retail sales, end up as a reversal pattern. This is a classical reversal pattern. If you are a short-term trader, now the market rebounds, and if it does rebound to a 50% point, I think that could be one point you can consider. If I am doing day trade, for example, and if I'm feeling particularly adventurous, I could possibly do something like this. I may even sell somewhere between this level of 4,138 to 4,144, and then put my stop just above 4,163, and then take my chance here. Okay, but you know, until we see a more conclusive reversal on the daily time frame, I'm not about to say that the market has already peaked, but it has the potential. So do stay on the lookout for that. In the Nasdaq 100 on the daily time frame, there is no classical reversal. There is possibility market may continue to chart even higher, although it does close a bit weaker on Friday. But again, you can see that the market has the momentum is still very much in favor of further upside adventure. Top side, I think, is 13,720. Okay, so there could be a challenge of this level, and I would be very interested to see if and when the market goes into this level, how price will react. Okay, I'm looking for reversal signal around this area here, and I want to see how the candle bar resolve itself on the daily time frame. Okay, over in the UK, prices continue to go higher. Now it is within my sell zone on a basis whereby the market has pulled back too deep. Okay, and this is definitely in favor of selling rather than buying. But again, right now, one element that's missing is a confirmation in terms of a reversal signal. I don't see any reversal signal just yet, but this breakout of prices does give me the incentive to look for selling signal, because if I sell somewhere within this bracket of prices between 7,864 to 7,950, and my risk is actually quite small because my stop is just going to be above 8,044. So on a relative basis, this is definitely a more conducive area to sell rather than buy. But what I'm missing right now is confirmation in a selling signal. There isn't any sell signal, not even in the 1 hour, not even in the 1 hour. So definitely it's a bit of a premature to call for a short. DAX, the German DAX is also trading at the year's high, and this is something that I cannot understand why, despite the poor fundamental, we can see index has German equity index is still trading higher. So in the absence of any technical confirmation, I'm not going to go and sell this thing. Okay, although it is ridiculous pricing, I think the valuation is may not be justifiable. Okay, so we will have to watch. All it needs is I just need 1 day of confirmation, and then this market has a long way to go if it decides to come back down. Okay, over in the Nikkei, we can see Nikkei continues to trade within a triangle. Now, if I squeeze this chart, you can see that the market is trading within a pattern in which the highs are getting lower, the lows are getting higher. So what does it mean? It means that there's a possibility it's going to move into a triangle, and if it does turn out to be a triangle, and the price will have to come back down almost immediately, because if this is a triangle, then prices should theoretically not be able to take up 28,735. Okay, but if it does, okay, maybe it is still too early to discard the triangle scenario, but the key here will be this level, 29,222. Okay, so if this level is taken out, of course, this is definitely not a triangle, it's something else. But in the meantime, unless all these levels are taken out, I'm going to keep to my triangle scenario, looking for further decay into maybe 26,000 half. Okay, area, and then we'll see from there what happens. The key here, if this is indeed a triangle, is to wait for the market to rebound one more high without taking out all these nearby highs here, and then market is going to come down in a very big way, in a very impulsive way, in a post-triangle thrust. But until that happens, we will have to watch. So right now, it's not a time to look at Nikkei as far as I'm concerned. Okay, in the Hang Seng, you can see that Hang Seng has actually managed to rebound from last year's low, almost at 14,600 all the way to 22,700. So this rebound has, I believe, is still very much in play. And the pullback that we saw since January of this year remains very corrective. And this correction doesn't seem to be over also. So there's a very likelihood that near term you may see a little bit of pullback somewhere towards the 17,400 to 18,000 levels before it stabilized, and then it started to go back up again, because I think this is likely to end up in the larger degree three wave, which will bring us to much higher prices. Okay, over in the Chinese mainland market, we can see that it's also very similarly a structure or a pattern very similar to the Hang Seng index. So you can see the rebound from last November at 3,500 all the way to 4,267. Now, this pullback here that we see is very corrective in nature, and there's a possibility it may pull back down to challenge this low here at 3,780. So let's see what happens going into mainland index. Now, I have promised to look into the KLCI and the STI. So last week I did mention briefly the prospect of the KLCI, which is the Malaysia stock index itself. Prices has been coming down, and each low has been getting lower and lower. So this is definitely a downtrend. So this downtrend is still very much in play. So this bounce here that we saw in mid-March is can only be seen as a corrective rebound. Okay, so how far this market can go, it all depends. If I'm going to take the start of this rebound from here to here, okay, what I can do is this. There's a possibility the market may actually start to topple from here onwards. Okay, yeah, a bit of a rebound. No, this is not winning color. Hang on. So I think the market right now is in the bracket of prices which is vulnerable to the downside. So Friday high that we saw traded to a high of 1,438 could be the high for this round. It's just likely to come back down again starting early tomorrow. So we will see whether this will pan out the way it is. The first support area obviously is 1,373. Okay, so downward bias is still very much evident in the KLCI. Okay, over in Singapore we also see something very similar to the Nikkei. We're getting highs are getting lower and lower, the lows are getting higher and higher, so we could end up very possibility also in a very similar triangle pattern. So right now not sure where the triangle bottom is going to be like, but let's say theoretically we draw a simple way like this, for example. Okay, of course this is not accurate. We need the market to actually find a bottom. So you can see that the highs are getting lower, the lows are getting higher. So it's moving into a narrow and narrow trading range. So that means the market is not ideal for trading. Okay, the market is just going to go into a period of consolidation based on the daily time frame. So it will have to find its level. So if this is A, B, C, D, E, again very similar, we're going to see downside risk. Okay, so like I say, this is very similar in structure to the Nikkei 225. So if the Nikkei 225 have the same structure and move in the same way in the same time frame, then look out for the same result. Basically the market come back down here without taking out the 2,968 and then rebound one more time without taking out 3,400 points and then 3,400 points and then have a massive collapse in prices. So that could be the scenario for the STI as well. Okay, now let's move off the energy. Crude oil prices remains very elevated. Three Sundays ago, we can see that the price actually bumps up, okay, because of the production cut by the OPEC Plus on top of what they had previously cut in last November, bringing the total production cut to 3.66 million barrels per day. So this is definitely having an impact. This week itself, we have the release of the CPI numbers, the PPI numbers, and then the retail sales that caused prices to actually spike up. In fact, after the release of the CPI numbers, prices actually went up to a week's high of $83.49. Now let's go back down to the lower time frame, and this is where you can see this is very pronounced. The market spike up, and this spike up here does suggest that price is going to go all the way up to my target at $88.60 before we can see any sensible pullback. So this is temporary for a time being the sentiment in the market. I think the market may not have any significant pullback. It may continue to chart even higher to $88.60 before we can see a pullback, possibly back to this level again, which is $79.26. We will see how this market pans out. Definitely, I have not had the opportunity to turn buying because the market never seriously pull back. But eventually it will pull back. Just be patient. Okay, over in the gold market, we see the triangle that we saw here. Market have a major breakout and then traded to a high this week at $2,048.80 on Thursday. And Thursday, what happened on Thursday? We have the release of the PPI numbers. Okay, and this was the market that actually goes up. And then on Friday, we have the release of the retail sales number, which is weak. Okay, and dollar basically rallied. So when dollar rallied, we saw a very sharp fall in gold prices as much as $55 per ounce. This is pretty sharp for gold market, and but it does not change the overall look and feel. Yes, a little sharper than what I would like. I'm still holding on to all my long position. I'm long basically somewhere around 1,960, and I'm long again just below $2,000. So now I'm holding on to all my long positions. I moved them all to stop it to break even. And if the market doesn't try the 1,983, I think there is still the possibility for the market eventually to go up to $2,073. Okay, so my target remains here. So let's see whether this level will actually come through. Okay. Over in the silver market, there's hardly any pullback until this week. Again, the market, before it pulls back, again managed to register a new high for this month at $26.09 before they have a serious pullback. But this pullback is currently stopped by this chart point here at $25.13. Not sure whether it will hold, but so far it does look like it respects this level here. So let's see whether it can actually hold. Now, if you have a chance to buy silver, maybe that would be the best place to go, because I think for now the silver it seems to be a better odds compared to, let's say, the gold market. When we look at this is the what we call the gold silver ratio. When you see a chart like this, it means if you look at it from the perspective of a FX pair, okay, gold is the constant here. 1 ounce of gold, how many ounces of silver do you need to buy one 1 ounce of gold? So this is very much like dollar yen or euros versus the dollar. One side is constant and the other side is moving. So when you see the chart falling, it means you need lesser and lesser silver to buy the same ounce of gold. It means silver is rising faster than the rise in gold. So this chart tells us that the opportunity is in buying silver, not so much in selling silver. Okay, so do watch out if you have a choice between to buy silver and buy gold. Ideally, you buy both, but let's say you can't and you have to pick one, then obviously the better choice based on this gold silver ratio seems to suggest that buying silver gives us more mileage. Okay, the only problem is that gold silver hardly pulls back to give us the entry levels. Okay, so right now we saw there's a bit of a bump up on Friday. Let's see what happens after this. Is it going to be a change in direction? So far, there is no evidence to suggest that it's going to be a change in direction, but we will have to see going into the new week itself. We have a long-legged shadow doji in this chart here. Usually, this could be seen as a reversal. So maybe for all we know, silver is going to take the lead in doing the correction this time. Let's see what happens. Okay, if this is the case, then maybe it is more advantageous to go into gold rather than silver for the time being. Okay, if this market actually will reverse, it means it is more advantageous to buy gold relative to silver. Okay, but over the longer term, if this trend does not change, then it means buying silver rather than gold is the way to go. Okay, over the dollar index, you can see dollar has been falling for all the way back in October last year at 114.75, all the way to most recent low at 100.42. And I did mention last week, 100 is a very nice round number, and I do expect, although the market actually traded to the year's low, okay, at 100.42, this is the year's low so far, and we have a bit of a reversal on Friday on the back of the retail sales number. Okay, you can see this is a classical, what we call a bullish reversal pattern. Okay, we have a new low and we have a new high. Okay, and relative to Thursday's price, which is this red color bar here, okay, because this is the daily time frame, right? So compared to the previous day trading range, this is an outside bar and it is a bullish reversal. So there is possibility dollar may actually bottoms. Now, if dollar actually bottoms, it means gold prices may continue to contract lower. So this is the correlation for now, because usually the gold and the dollar market seems to be negatively correlated. So if that's the case, let's see whether the dollar remains is able to hang on to its gain in this coming week itself. I'm basically still long the US dollar index. I've been long the dollar index for quite some time. So I've been holding this position because I do believe the very likelihood of the round number 100 to hold is actually very good, and actually have a buying range. Market is at 100.44 to 100.83 since my buying range. So it came in at the lower end of this buying range here, and the market actually reversed. So I'm going to continue to hold on to my long dollar index position. Earlier on, last week when the market late last week when the market actually rebound, I actually pared down some of my long position because I have quite a bit of long position open, and despite the market not able to go up, I decided to pare off those at the bottom, which they are not underwater, they are basically positive. So I got up those that are positive, hang on to those that are still negative, hoping that the market will actually hold at 100 here, and so far it looks like it's panning out to be pretty well. Let's see whether it can continue to hold on to this gain going into the coming week itself. So if dollar is going up, obviously all the other major currency pair would have to come down because it is a seesaw, right? Dollar goes up, the rest comes down. So this has always been a tradition. Now sterling versus the dollar went up to a high of 125.45, breaking the previous high 125.25 just marginally by 20 pips, and then we see this reversal on the daily time frame. This is again a bearish reversal because we have a new high traded at 125.45 and then market closed down to 124.13. So if we go down to the lower time frame, let's say we look at the 1 hour time frame, do we see something a little bit earlier? Okay, we don't see an earlier sign that market is going to topple over, but let's go to the 4 hours. 4 hours, we also don't have very clear sign. So this market suddenly reversed with no signal that it's going to come back down. So this is the case here. So in the meantime, we will have to look at it from the dollar perspective, saying that, okay, the market has a potential to reverse because the dollar index suggests that a bottom could be in place in the dollar index. And while my target was at 126.60, okay, this target may not come in the near term. So whether it will continue to go lower, we'll have to see in the coming days. There is no particular chart point that suggests that we could have some kind of a holding area. But technically, if you look at a pivot, okay, we have one high here at 123.45, and then we have a low here that actually hold. Here is 124.43. So somewhere between 124.40 to 124. Yeah, 40 levels. Okay, I think this level should act as a temporary bottom here, technically speaking. So from the chart point, this level could actually hold this market for the time being. So let's see whether the market reacts around these 23.40 levels. Over in the euro, very similar. The euro actually ran up to a high, okay, at 110.75 before it starts to come back down. But we do not technically, yeah, we have a marginal case of a bearish reversal because this one is an outside bar. Let me blow up the chart for you. Yes, we have a marginal low compared to Thursday. We have a marginal high compared to Thursday. So technically, it is very similar to what we saw in the British pound, sterling versus dollar and euro versus dollar. Both has a bearish outside bar. Okay, now this is getting very close to my ideal target range of 110.92 to 111.30. Okay, however, unfortunately, my short position was stopped out as a market rally above 110.33 this week itself. So I have currently no position in euro versus the dollar, but let's see what happens, because if the dollar wants to reverse, you will take all this currency pair down. Now, if it further breaks below this very simple support line here, and then further take out the 108.30, then the market is definitely going to go down all the way to 105.16. Okay, so do watch out for the possibility of further breaks to the downside. Over the Aussie market, the market is actually quite interesting because we have a bit of a reversal going into Friday trading. Market was actually running up all the way, which is contrary to what I thought is going to happen. I thought the market is going to go down all the way before the market rises to 0.6565, but the market actually went higher to 0.6805. And then just when I thought it's going to go even higher to 0.6850, which I'm prepared to sell, the market actually do a sudden reversal. But of course, you can see this is a time when the market actually reacted to the retail sales number, and we have this long-legged shadow doji, which is usually seen as a reversal signal. Let's go down to the lower time frame. We have a bit of a volatility going into the retail sales number on Friday, and this is the result. The market actually went out all the way down and without any rebounds, even as the market closes for the week itself. So the low traded on Friday was 0.6695, and it does bring back the bearish scenario because this drop here is rather severe, and it does shake out a lot of people who have been buying. I'm very sure people who have been buying this will be shaken out after last Friday's plunge in the Aussie rate. So this brings back to the original assessment. Market may actually try the 0.6565. Okay, dollar yen. I did one trade correct on Friday. Just minutes before the release of the retail sales, I actually went in to buy, because after the market reacted on the positive side on Thursday itself at 132, because I was expecting 131.90 to 132.30 levels to actually be a support area, but I didn't buy then, okay, because I was waiting for the reaction, and I didn't see any reaction, but I saw a consolidation minutes before the release of the retail sales, somewhere the market was around here. I went in to buy, and the market took off to test the upper end of this recent range of 134. Okay, let's see whether this dollar reversal will sustain into the in the coming week. I think there's a very good chance it may actually sustain, because this is part of possibly part of a wider three-wave rebound. And if this three-wave rebound is correct, then my target is at 134.75. So I think there's a little bit more room to go, maybe another 100 pips go before it hit my target, and that's where I will exit my long position and then watch. There's a possibility this thing may come back down again, but again, let's see. Okay, but for our time being, the momentum suggests that there's a very good chance this dollar yen may go and test the 135.75 to 135.70 areas. Now, dollar Canadian has always been mimicking the price structure of the dollar index. So as the dollar index stabilized at 100.42, the dollar versus Canadian also stabilized at 133 even. Very nice number, and it hit my target. And so now you can see that the prices has a bit of a run up in prices. There's a better possibility that this thing may continue to, at least for those people who have been short, they will continue to short cover. And if this short covering continue to bring in new fresh buying interest, then this market have a good chance of continuing to go up to test the 135.50 levels. Okay. Now this is Bitcoin. Now Bitcoin has a very, very good run. It has been going up quite consistently. We can see that the low traded here was actually in mid-November last year, okay? And the prices has never looked back. The low traded of 15,479 and then went up to a high of $31,035, okay? So this is the week's high on Friday itself. Yesterday, very little movement. Today, we have a bit of a pullback. So by and large, you can see that the continuation of this rally here have legs. It does suggest that there will be further upside, you know, especially after Ethereum has gone through the Sapila upgrade, which is what you call a what you call that? What's the word used? But basically, this is an upgrade in their blockchain technology that make it more efficient. So it has successfully launched, and that gave Ethereum a kick up to the upside, and which also take the Bitcoin along for the ride. So by and large, if we see a pullback, there are two schools of thought. Maybe the market will continue to go higher this coming week, okay, beyond 31,000. I've always maintained somewhere between 32,000 and 33,000. We could see a temporary top for this run, okay. But for a time being, there's a possibility the market may continue to pull back somewhere to 29,700 levels, or maybe even deeper to 28,650 to 29,000. So anywhere between 28,600 all the way to 30,000, I think is still technically speaking, still a little bit of possibility to buy for another run up in prices. But again, be very careful. If my target is about 32 to 33,000, I think that's all we can do for now. Then if you are day traders, then of course this you have to make sure that you do a calculated risk to see whether it is worth your while to do a buy. But for now, I definitely not going to buy this thing because it's very, very high. Okay, so there we have it. For the time being, this is all I can do for you this week. And do keep up for updates. I did tell you guys that I actually intend to do something for you guys, whether to give you periodic lessons or to give you a more regular updates on a daily basis. Right now, I do have another service which I'm only opening up to the to subscribers, people who actually subscribe. Basically, they are brokerages who they subscribe to my daily commentary. Each day, I will pick one product in which to talk and to bring you the very short-term outlook. If you have interest in that one, I'm more than happy to let you in on the subscription. The other one is a daily updates, in which I talk about all these markets, but in a very in a more in a very short video clip that lasts no more than 15 minutes. If you think that is going to be helpful to you, instead of waiting for my weekly update, you can also subscribe to my daily updates if that's something that you think that will be helpful to you. Do let me know by writing to me. You know how to reach me. So I probably will do a poll to ask you guys on my next Sunday webinar, so I can get a sense of whether is there enough interest for me to even launch it to you. Okay, so in the meantime, you take care and be safe. Bye bye.